Welcome to Standard Chartered Money Insights, a podcast series by Standard Chartered Bank that brings you market views and insights on the go.
Welcome to Cut to the Chase. Today is Tuesday, the 16th of January. I'm Daniel Lam, your host for the podcast. I have no doubts that over the past couple of weeks, many of you have been attending various investment outlook seminars for 2024. Now, while the focus would always be on the predictions for this year, to me personally, in a mischievous way, I find it equally interesting to recall what was being pitched on the street in such events over the previous years, which did not play out. Well, in January 2022, many were still looking for the transitory inflation in the US. And in January last year, the continued strong economic recovery in China post the reopening. Now, fast forward 12 months, the weakness in the Chinese economy is still clouding the investment outlook in its risky assets. Now, in our very first podcast this year, we spoke about the encouraging moves in the Hang Seng Index at the end of last year. But since then, the index has been coming off gradually and barely holding its key technical support at 15,972. Now, no doubt, valuation continues to be cheap, and we may see some rebound in the Hang Seng Index, well, say to just above the 17,000 level. But we continue to believe that Chinese assets can truly turn around only if the government carry out strong level of stimulus to the economy. Now, there will be heavyweight Chinese data this Wednesday, for example, the GDP, industrial production, and retail sales. Now, the latest macro figures were rather mixed. First of all, the December trade data beat expectations on both import and exports. But the inflation data remains bleak, with both consumer and producer prices continuing to fall. And also, credit expansion remains muted, with Chinese total social financing and also loan growth both below expectations. Falling home prices combined with deflation is resulting in balance sheet recession dynamics. So that reduces the effectiveness of monetary policy, and low interest rate is not boosting credit demand because households and private businesses prefer to, quote-unquote, play defense and pay down their debt instead of entering new projects. We need to see strong fiscal stimulus from the government to boost demand in order to turn this situation around. Hence, we continue to hold a neutral view on Chinese equities. Now, within the AXJ region, we prefer Korean equities, which we went in depth in our podcast last Tuesday on the back of the positive outlook in the global semiconductor sector. Globally, we have overweight in the US and Japan equities. That is all from me for today. As always, if you enjoy this podcast, please don't forget to rate and like it. Thanks for listening, and we wish you a happy day ahead.
Thank you for listening to Standard Chartered Money Insights, a podcast series by Standard Chartered Bank. For more details, visit Market Views on the Go on our website or click the link in the description.